Welcome back, everyone. I hope you enjoyed your break and are ready to dive into the next section on policy provisions, options, and other features. Some of these features we've already touched on, but now we'll explore them in more detail. Instructor introduces the insuring agreement. First up is the insuring agreement or insuring clause, which is part of the EPIC acronym for the parts of a policy. The insuring agreement is the core of the contract, stating that in exchange for the premium, the insurance company agrees to pay the beneficiary the death benefit upon proof of the insured's death. It's the essence of the agreement between the insurer and the policyholder. Instructor moves on to the ownership clause. Next, we have the ownership clause, which outlines the rights of the policy owner. The owner has nearly all the rights associated with the policy, such as changing the beneficiary, converting term to whole life, adjusting the premium in a universal life policy, and increasing or decreasing the face amount. However, the one thing the policy owner cannot do is change the insured. Instructor explains the entire contract clause. The entire contract clause specifies that the policy, the attached application, and any attached riders make up the entire contract. It's important to note that it's the entire contract, not just the whole, complete, or comprehensive contract. This clause also states that no statements made outside of these three documents can be used by the insurer to deny benefits. Neither the agent nor the client can make changes to the contract outside of what's included in the entire contract clause. Instructor discusses the incontestability clause. The incontestability clause gives the insurer a 2-year window from the date of issue to contest the policy based on a material misrepresentation. After those 2 years, even if the insured lied on the application, the insurer cannot deny the claim. For example, if the insured was treated for a heart condition, but stated otherwise on the application, and then dies of a heart attack 6 years later, the insurer would still have to pay the claim because the 2-year contestability period has passed. Essentially, after 2 years, a lie becomes the truth in the eyes of the policy. A misrepresentation is a misstatement or lie that can be intentional or unintentional. A material misrepresentation is a lie that is significant. It is one that, had the truth been known by the insurer, a different underwriting decision would have resulted. In order to void coverage, within the first 2 years, a lie must be material. Instructor, the grace period is the time during which the policy remains in force, even if a premium payment is missed. By law, the grace period is 31 days from the premium due date. If the insured dies during the grace period, the insurer must pay the death benefit minus the past due premium. So Dawn, if Pearl missed a $200 premium payment and then passed away within the grace period, you'd receive $449,800 instead of the full $450,000. If the insured dies after the grace period and the premium remains unpaid, there's no coverage. The reinstatement clause gives the policy owner the right to reinstate a lapsed policy within 5 years of the lapse date. Let's say Pearl bought a policy at age 30, paid premiums until age 45, and then stopped. At age 49, she decides she wants the policy back. She has the right to reinstate it, but she must prove her insurability and pay all past due premiums from ages 45 to 49, plus interest. If she had any outstanding policy loans, those would need to be repaid with interest as well. The advantage of reinstatement is that Pearl would be paying premiums based on her original issue age of 30, which could be much lower than buying a new policy at age 49.
Why would the insurer let someone reinstate an old policy? instead of just making them buy a new one at their current age?
Great question, Don. The reinstatement clause is a consumer protection feature. It gives policyholders a second chance if they've fallen on hard times and let their coverage lapse. The insurer does have the right to reassess the insured's risk, but if approved, the policyholder gets to keep their original, more favorable rates. The misstatement of age clause addresses situations where the insured's age was stated incorrectly on the application. If this happens, the insurer has the right to adjust the death benefit to match the amount of insurance the premiums paid would have purchased at the correct age. Instructor provides an example. Let's say 40 years ago, Pearl stated she was 29 on her application, but she was actually 30. She'd been celebrating her birthday in May for the past 70 years, based on what her adoptive parents were told, but her real birth certificate shows an April birthday. If the insurer discovers this discrepancy, they won't make Pearl pay the difference in premiums for the past 40 years. Instead, they'll calculate how much coverage a 30-year-old would have received for the premiums Pearl paid. If $2,400 per year would buy a 29-year-old $450,000 of coverage, but only $442,600 for a 30-year-old, then upon Pearl's death, Dawn would receive $442,600 instead of $450,000. Instructor discusses the assignment provision. The assignment provision gives the policy owner the right to transfer some or all of their policy rights to another party. There are two types of assignments, collateral and absolute. With a collateral assignment, the policy is used as collateral for a loan, like a business loan. The lender becomes the collateral assignee and has the right to change the beneficiary to themselves and place restrictions on the policy owner's rights that could affect the policy's value. If Pearl assigned her $450,000 policy as collateral for a $250,000 loan and then died with a loan balance of $250,000, the insurer would pay $250,000 to the lender and the remaining $200,000 to Dawn, the original beneficiary. The lender cannot access the policy cash value or make any changes beyond protecting their interest in the loan. An absolute assignment involves the policy owner transferring all rights under the policy to another party. This might be done for estate planning purposes, to remove the policy from the owner's estate. The new owner has full control over the policy and can make any changes they wish. Conversion or change of plan provisions allow a term policy to be converted to a permanent policy, like whole life, without evidence of insurability. Earlier, we discussed Pearl buying a 20-year term policy at age 30 and then converting it to whole life at age 45. The new whole life premiums would be based on Pearl's attained age of 45 rather than her original issue age of 30. The sooner a term policy is converted, the lower the new whole life premiums will be. The excess interest provision states that if the insurer earns a higher return on their investments than anticipated, they may credit the additional interest to the policyholder's cash value. This provision allows policyholders to share in the insurer's financial success. Instructor discusses the free look provision. Finally, the free look provision gives the policy owner a 10-day window from the date of policy delivery to review the policy and decide if they want to keep it. If the policy owner chooses to cancel the policy within the free look period, the insurer must refund all premiums paid. This provision gives consumers a chance to make sure the policy meets their needs without risking their premium dollars. Instructor checks for understanding. I know we've covered a lot of ground today. Are there any questions about these policy provisions and options? The class is silent, indicating understanding. Fantastic! You're all doing a great job of following along and grasping these important concepts. Remember, understanding these provisions is crucial for both agents and policyholders as they define the rights and responsibilities of all parties involved in the insurance contract. Great job on completing this video. Now it's time to test your comprehension of the concepts we just discussed. This video corresponds to ECAP quiz course number 24. Remember that number. Click the link in the comments section to access the Insurance Class Assistance Program, also known as ICAP. Once you're there, look for quiz course number 24. This quiz will help us see if you truly understand the material and are prepared to move on to the next video. Don't forget, ICAP quiz course number 24. Good luck and keep up the great work.